Welcome to Take 10. I'm Jennifer Madden. Over the past 2 years or so, we've been seeing a lot of houses on the market, buying and selling. But what does this mean about housing prices here in New Jersey and across the country? Well, joining me now to talk more about this is Joe Meyers from Meyers Associates. Once again, thanks for joining us on Take 10.
Thank you and Time Warner for having me.
So, Joe, I have seen so many houses going on the market over the last, say, 2 years. People are picking up these houses very quickly in New Jersey and around Bergen County, but it seems to slow down a little bit. Do you see this, or is this just seem to be going on across the country, or is it picking up? Or?
I believe we've witnessed a top in housing, and I think very coincidentally, we've had a bottoming of interest rates as well. As you know, over the last 2 years, we've had a tremendous record number of refinancings. We've also seen housing prices in the last 5 years appreciate 40%, and we've also seen the amount refinanced increase by 60%. So I think we are at a top of housing. I think as interest rates continue to move back up, we're going to begin to see housing move down. Move down,
because it almost seems to me now houses aren't selling as quickly as they did, say, like a year ago.
That's true.
Is this because the prices are going up too high? Because I know like friends of mine that have bought houses for $249,000, whatever, and now they're close to $500,000. And then they're selling their houses and moving out of state, actually, to like Pennsylvania to buy these big houses, but where actually housing prices are a little better. Could this be a trend that's going to be starting, where people could be selling houses, say, in Jersey, and moving out to places where they can where they get more for their money?
The highest real estate markets in the country have been New York, New Jersey, and California. And we've seen record number of refinancings in those markets. We've seen record housing prices. I think we've reached a point where the prices of these homes is basically unsustainable. I think we've reached a point where it's an absolute paramount that you have two incomes to be able to come ahead and service the mortgage debt. The economy is still losing jobs. We're still in a very tough job market. I think we're going to see housing start down, and I think we're going to continue to see mortgage rates move up. We now have mortgage rates. A 30-year mortgage is approximately 6.25. I think we're going to see possibly 7% by the end of the year, and possibly 8% over the next 12 to 18 months.
Now, for a homeowner right now that maybe bought their house 4 or 5 years ago and has seen it double, maybe triple in price, and they're thinking, you know what, maybe I'll sell now and I'll buy something else. And is this a good thing to do? I mean, obviously people are trying to look for housing and as a form of investment. Is this a wise decision, or should you just hold on to what you have?
I think it would be a wise decision to sell an overvalued home and take the money and move into rent until such time as prices correct. And I strongly believe that they will. I think if you do move into rent over the short term and you do invest that money wisely, I think in the next 18 to 24 months you possibly could move back into the real estate market once again and pick up a tremendous bargain.
Joe, we're just going to take a quick commercial break. When we come back, more about real estate today here in New Jersey and all across the country. So stay tuned. Once again, welcome back to Take 10, and joining us once again is Joe Meyers from Meyers Associates, giving us some great advice on our financial future. Once again, thanks for joining us on Take 10.
Thank you.
So we closed up the first half talking a little bit about real estate here in New Jersey and across the country, and saying the highest real estate markets are in New Jersey, New York, and California. Are we still going to continue to see this?
We have witnessed the lowest interest rates in 45 years, but we've also witnessed within the last year the highest number of mortgage foreclosures since 1973. And I think what that's telling you is it's becoming increasingly difficult to service debt. The mortgages that have been placed on these homes, you could basically come in with 5% down, basically finance 95% of the purchase price. And people are now, with the economy attempting to prolong its recovery, starting to see the difficulty in being able to make these mortgage payments.
Now, I mean, is this going into other areas as well? I mean, that people aren't able to make these mortgage payments? I mean, obviously you're seeing a lot of foreclosures. How can someone prevent this from happening?
We have witnessed the largest explosion of debt over the last decade in the history of the United States. We now have total indebtedness of $31 trillion in the United States, 3 times the gross national product. We recently, in the last 12 months, have seen over 1 million people file for bankruptcy. So we are starting to see debt be a major problem. It's a major problem for corporations, but more importantly, it's a major problem for individuals. Going back 10 years ago, the typical credit card debt was between $6,000 and $8,000. It's currently now between $18,000 and $20,000. And even though we've seen interest rates fall to historic lows, the average credit card is still carrying an interest rate of 14%.
So with an interest rate of 14% on a credit card, how does somebody get themselves out of that debt?
They don't, quite frankly, and they file for bankruptcy. Because when they make the minimum payments, as you know, it would literally take 30 years to pay off the account. And the credit card companies have become more liberal over the last 5 years than ever before. They've increased the credit lines for a lot of individuals, and we've had people basically abuse credit, and we're at the point now where people have maxed out these credit cards with no hope of ever repaying the debt, and they're basically turning to bankruptcy as an alternative.
So what is the hit to the banks and the credit card companies? We're talking about mortgages being foreclosed on. We're talking about bankruptcy. What does it mean for the banks and the creditors that aren't getting their money?
It means that we're going to see higher interest rates because of it. It means that the economy, even though we are seeing improvement in some sectors, I believe is still continuing to deteriorate. We currently have only 25% of our manufacturing capacity which is operational. So we're basically now at the point where we're not an industrial power anymore as we had been in the 50s and 60s. We're basically servicing foreign products. And I think as the job market continues to deteriorate, as we start to see people downsizing their lifestyle and moving into lower paying jobs, we're going to continue to see more bankruptcies filed by the consumer.
Now, is there a point where there will be no, like they can stop you from claiming bankruptcy and foreclosing on a mortgage and making you pay this debt back?
Over the last 2 years, we've seen federal legislation which has made it more difficult to file bankruptcy and discharge your indebtedness. Over the years, there had always been federal legislation that prevented a student from going forth and filing bankruptcy and discharging their student loan. We're now starting to see lenders look a lot more critically at the overall financial well-being of an individual prior to providing the kind of credit that they had very easily given several years ago. So it is a much different market. It's getting a lot tougher.
Joe Meyer from Meyers and Associates in Florida, thanks for joining us once again on Take 10 and giving us some advice on how to keep our financial future on track. And thank you for joining us as well. Stay tuned for more Channel 10 News, more sports and weather are coming up next.